The U.S. Federal Reserve announced it will not extend the temporary relief on capital requirements for banks. Now, following the news, some of the bank's shares dropped and the benchmark 10-year Treasury bond yield rose. Our business correspondent SEO Eun-kyung brings us more details on the potential impact on the market.
The Federal Reserve loosened the Supplementary Leverage Ratio, or also known as SEO, in May last year, but last Friday decided to let the temporary change expire as scheduled on March 31st. The change was aimed at providing flexibility to banks so that they could provide credit to households and businesses during the pandemic era. SAR is defined as capital over total leverage exposure, with leverage including stocks, derivatives, treasuries, and bank reserves. The temporary change also allowed banks to exclude U.S. Treasuries and central bank reserves when it came to calculating their leverage ratio. The banking industry was longing for the exemption to be extended because the Treasury bond yields could increase further if banks sell their Treasury holdings to meet the required SAR ratio. However, the financial authorities took the opposite position. The Fed said since the largest banks have about $1 trillion in capital, ending the temporary relief would only slightly shift ratio levels. The central bank also noted it will look for public comment on ways to adjust the supplementary leverage ratio. Following the Fed announcement, bank stocks fell. Wells Fargo dropped near 3%, while both JP Morgan and Goldman Sachs saw their shares sliding more than 1%. The 10-year U.S. Treasury yield on Friday was sent to as high as 1.749%, hovering around its 14-month high. But the figure settled down to 1.732%, with little change from Thursday's close.
Overall, it is inevitable to see Treasury bond yields continuing to rise, as well as inflation. Treasury and stock markets would be heavily affected by the Fed's gradual reversal of a quantitative easing policy.
The expert added that when interest rates go up, some emerging markets will see cash outflow to the U.S., but at the same time, some of the U.S. key trading partners would benefit from it. SEO Eun-kyung, Arirang News.